A special guest today is Matt Amberson. Matt is the principal of ORATS. Matt started ORATS to provide clients with more accurate and realistic options research than was currently available. The roots of ORATS were in Matt's successful SIBO market making and options trading firm. Now ORATS caters to the largest pensions, banks, hedge funds, and also individuals, giving access to proprietary options information and backtesting. Matt has a master's from Kellogg, a CFA Level 1, and holds a CPA and RIA designations. Welcome to the show, Matt.
All right, Andrew. Nice to be here. Thanks for the intro.
Let's dive in. Tell us about ORATS. What does this company do? It's options, but who's it for? What kind of services do you provide?
Yeah, thanks. So it spun off of a successful trading floor operation where I backed traders and put them on badges, but brought them upstairs to help with us with the proprietary calculations around options. Back then, there wasn't a whole lot that you could get. But now we've hired some great programmers, and we have quite a bit of information that we're calculating that's not generally standard. We do all the standard implied volatility stuff, but we have hundreds now of data points that quants come to us for, or people just looking at our charting come to us for. And then what happened was people said, well, we want to know how good your forecasts are. We want to know how good this proprietary data is. So we said, well, we could do a R squared or we could do a back test. So we put together this whole back testing platform, and that's got a life of its own. So we became known for that. From that, then people just pull from the customers. Well, now we want to see that scanner. Now we want to get alerts when we should be trading and implementing this back test. So that's really the genesis of ORATS and where it's gone. And we could talk later about where it's going.
So it sounds like all of these changes and adaptions are coming at the request of traders, people that come and use the data and they start and they want more. And the requests just seem to keep coming. And is your mentality, we'll just keep building the features that make folks more successful, and that will make a successful business?
Yeah, that's one of my problems, and that's one of the good things about ORATs is I read this book on what type of entrepreneurs people are, and where I fit in as a craftsman. I think I liked the craft, and I really enjoy my clients, and so now what we're trying to do is predict where the market's going. It's really been interesting to see what's happened to the market. At first, we had a lot of larger banks and hedge funds come in that wanted to backtest, let's just say, hedging their portfolio. So they would look at, it's really expensive traditionally to hedge, and what is the best way to really do it? So we would do these millions of backtests for them. And then the market started to splinter a bit, and a lot of our clients were from quant backgrounds, and so then they'd come in and say, we want a lot of data. We just pack us down with data and these proprietary calculations. And then recently with COVID, there's been a lot of people in their houses and trying to trade, and it's been interesting to see, because we could see in our data how it's changed the whole surface of the applied volatility, and also how much shorter term people are getting. Before we never had it's called zero DTE. It's like everyone's asking for that, and zero DTE means I get in with no days to expiration. DTE means days to expiration. So all these options have a finite life. And usually, people would trade, they go out to the longest leap is 2.67 years. And, then the exchanges started adding weekly options. And now you could get daily options this year. So everyone's trading, and that's one of the huge challenges that we face. It's the number of expirations go up. And then every stock has all these strikes underneath each expiration. So there's just a massive amount of data, and people are getting more short term. People are buying these out of the money calls. You could see that in the skew. So that's that's how we followed them. You have to pivot, and so that's what we've tried to do at ORATS.
So you're talking people are now asking for a contract that expires today. That's the that's a 1 day expiration contract, and that's got to be new, right?
Yeah. So
Wow.
what happened was, when I was a trader, we used to be on the floor, and expiration used to be the hot and heaviest day. We'd leave the floor and just face plant on my bed, and it was, because everyone had to roll their positions and everything. And now there's a face plant every day. Like every day is an expiration
Oh
day
my
now.
gosh.
That was unheard of before. And so that's yes, the exchanges have responded to what the clients want, and then obviously ORATS is responding to what the clients want and what the expirations or the exchanges are doing.
Wow. And do you think that that's being driven, that short-term mentality? Is that like pure speculation, or can people actually succeed in that world where you're constantly 1 foot away from the grave?
Well, yeah, it's interesting because I trade in my personal account, and I like to test out all these things, and it's really fun, And it's also, I think it also puts things on an even footing a little bit more.
Okay.
It's when you're talking about 1 day left. Today the market's down 2.8%, and the market makers have to change all these markets, and things are going crazy, and then you have immediate feedback if you're trading that 1 day,
Sure.
and longer term back tests and more macro information that maybe a large bank might have an advantage over an individual. For 1 day left, it's just kind of a crapshoot in a bit, and it's a little bit more of a kind of intuition gambling mentality
Mm.
where in some respects it levels the playing field, if you could find some edge to do it.
Sure. So if you're an individual trader, you're competing against a hedge fund that has $100 million data budget. You're never going to win in the long-term game, but today you might have a shot because they don't have an advantage because nobody really knows.
And it's pretty young. I mean, we just started back testing 1 day calendars. So a calendar is when you buy 1 month and sell the other month, and that's never existed before. And
Wow.
so, our back tests we're doing in probably the same time as these big hedge funds and big banks. So it's you're on the Wild West, right? And
Yeah.
so that in a sense levels the playing field because there's no data that exists. It's only this year that you've had all this amount of data. So it's interesting. We're getting a ton of requests for that type of thing, and I think that retail and instinctively goes to places where they think they can compete, and that's where it is in really short term options now.
Interesting. I mean, it does sound fun, and I like the idea that there's a level playing field that emerged out of that. But I can't imagine what your server costs are to keep up with that much back testing. I mean, it's got to be enormous amount of processing going on because there's so much data to back test against. It's not like stocks. Is that something you guys keep an eye on?
Oh, I mean, that's our daily challenge. So back in the day, we used to have servers, and we used to, at night, we used to have a thermometer that we'd have to monitor, seriously. And if the AC went down, if it was a really warm night in Chicago,
Yeah.
we couldn't enjoy ourselves because we were running to the office to open the doors and blowing everyone else's air conditioning.
Yeah.
So, but then what happened was the cloud came, and that's been awesome for our firm.
Sure.
It's amazing what you can do in the cloud. We were on a technical call today trying to figure out how to break up and reformat our databases so we could be more responsive on indexing all this data, because you can't, whereas before we used to give a whole snapshot of the entire market. It's way too big for people to handle now. So
Mm.
we're dealing with these ultra fast partitions and snapshots and stuff so we can start to get at some of the data that we're calculating, and we figured out how to calculate it very quickly. I'm able to work with some awesome text. So I have a little bit of programming background, but I have enough so I could say, okay, here's a way that we can interpolate something instead of having to go through a huge option formula calculation. We could interpolate and get it, 700 times faster. And so then we could blow over the whole surface and then have a slow calculation going here and continuously talking. So, the tech has really interfaced with the necessities of good calculations. And that's where we're living, on that edge, and trying to get the calculations as good and as fast as we possibly can. But it's an amazing amount of data, as you mentioned.
Wow. Yeah, I like to think that you used to probably be operating two companies. You've got the options, the analytics, all the data, but you're also like a server database company doing the job that is now a whole other company. And now that you're in the cloud, you don't have to. You can focus more on the other part of your business. And I bet your clients think about you that way. They don't have to do some of these calculations. They can rely on a lot of upstream processing. Is that one of the advantages they're getting, is that they don't have to be thinking about these partitions and how to make the data more accessible?
Yeah, absolutely. And their expectations are so high. They're
Mm.
like, well, you could just give us this, and like, you have no idea. And then and what we've done is we've actually built UI. So we've built things so they could see it. And once they're able to see it, and then we built scanners on it. And then because we have that direct access, and so we could sell not only just the data, but we could sell the tools to access the data, like the scanning data, the backtest. So we have backtest APIs, scanning APIs, chain summarization APIs, and
Wow.
and so we're having to, really, there's a lot of demand from these quants, and they really have high expectations, and so we're having not only to host all this stuff, but we're having to. And it helps our business, of course, but we're having to provide access to it, and all the things that you mentioned, the partitioning, but also the scanning, and then the UI, so they could visualize it and then start to see where they could use it in their own way.
Wow. So this data that you're providing them, I've been on your website. It's orats.com. If anyone listening or watching wants to check it out, you talk on there that having alpha, it comes from quality data. So when you've got access to these tools, you've got access to the information. That's when you can start to succeed. These quants are demanding, but it sounds like they're relying on you to help them find that alpha. Can you talk a little bit about finding alpha in the data and like why you need all these tools in order to get there?
Yeah, definitely. So, and what we do is we've worked with AI firms, we've worked with machine learning, and so we're actively going after and trying to find the edge in our data as well. And then once we could do that, then we could say, hey, take a look at this data set. We have these massive hedge funds that have people all over the world just pounding on our data. And they're buying everything that we put out, like every new data set they'll buy. So we know there's something in there that they found, and then we try to help out our other clients figure out what type of obscure calculations. I'll just give you one. My favorite one is, and this is going to be like totally off the wall, but there's a way that you can look at volatility in 30 days, and there's a way that you could look at volatility in 60 days, and then there's a way that you could look at what the volatility will be between the 60 days and the 30 days. Mm-hmm. And there's a calculation for that. And then there's another calculation that we used to use on the floor for that. That's a different calculation. And then that relationship between those two calculations is one of the best market predictors of duress coming in the market. So, and if you followed all that, so, we just have these calculations that we didn't know that were going to be interesting, and what they were going to be useful for. But this one shows when that valuation relationship gets off, there's something happening that's weird in the market, and then that usually shows that there's something going on bad. Like this last meltdown that we've had, we were looking at the market and we go, this is really looking bad from our signals, but the market was still kind of sitting there, and it's really but those types of things are really canaries in a coal mine. And so we're able to look at a lot of this proprietary data and find it with all these AI and machine learning types of programs to help us identify where we think our edge and our alpha lie. And then when we communicate that to clients, and then now we have backtesting platforms that we can show them, and at least historically in a backtest, that these are good alpha generating indicators. So that's the challenge, and that's how we try to overcome and help our clients with that challenge.
It sounds like an inverted yield curve, almost like when yield
Yeah.
curves, short and long term, aren't lining up how they should. That's your warning signal, and you can see that in the options market as well. Tell me even more, like the data, like if you didn't exist and people wanted to do this on their own, they wanted to try to find alpha and find all of this. Are they looking at like a multi-year project to try to organize all this data? And that's why if you don't already have the data in the formats you have it in, you're never going to get anywhere. Is that kind of the challenge that people would face if you didn't exist?
Yeah. Anyway, that's a really good analogy, the yield curve analogy. I'll use that one in my marketing coming forward. So thanks,
Sure.
Andrew.
You bet.
No, I mean, when people say I'm just going to do it myself, I'm like, good luck. Like, I CPA, CFA, like in programmers, and we've been at it since 2001, and before that, since the mid 90s, trying to, come up with all these calculations. Even that forward volatility calculation is extremely difficult to do and compare and to find it. So I'm like, yeah, you could do that, but where is your bailiwick, to use a very old term? Is it trading, or do you really want to go and spend the millions of dollars that we've spent and try to do all this? And we, and it's so competitive to sell data. Exchanges, they have such a monopoly that they take so much money. And so we have, we're set, fighting for the kind of the scraps after the exchanges.
Sure.
And then, it's not that great of a business, I don't have a ton of pricing power like the exchanges do.
Sure.
So you should use this, all the work that's been gone into it. I think it's a fabulous value, actually. So, because they could get it, they could use it. All you need to do is concentrate on what you're good at, finding a niche and, trading niche, whether that's from a quant perspective, a visualization perspective, or whatever. The data is there. It's so difficult to calculate. So I'm like, yeah, if you want to try to recreate this, go for it. But it's really difficult.
Right. I like to think of all those headaches that you've solved, from cooling off your servers with a fan or something, like, to doing all these calculations. That's your moat, your competitive
Yeah.
advantage, that if somebody wanted to start from scratch, they'll catch up in 10 or 20 years. And it sounds like it is working for your clients. So like these hedge funds, individuals, businesses, traders, they are able to find alpha and get a good return because they're using your service. Do they give you a lot of feedback like that they're like, oh, this is great. If I found some answers in here that have allowed me to be a better trader. Is that pretty much the feedback they're giving you? I mean, you're still in business, so it must be.
Yeah, I mean, another bad thing about my business is when they find something, they're secret about it. Like in other
Okay.
businesses, they're
Interesting.
like, yeah, they found they speak it to the heavens, right? Ours is like, they're so tight-lipped, and they go, and then they go, what about that earnings forecast that you have? I go, they're looking at that. So like then you'll figure out where they're finding edge in the data. But yeah, the problem, you're not going to hear it from clients, right? Because
Yeah.
they want to make their moat, and their moat is getting data that has edge, that and they want to share it as in a small way as possible. So they're not going to, like, we have a lot of great feedback, but they're not going to get real specific about what they're using of ours, unfortunately.
What a fascinating problem where your clients
Yeah.
don't want you to know what they're doing. I mean, yeah, that is a really a tricky, interesting problem. Do you enjoy it? Do you enjoy solving these data science problems? I mean, you sound like a data science manager. You're talking about, we're going to apply AI and ML here. We're going to architect this here. We're going to dig over here for exploratory analysis. I mean, it sounds fascinating. Like, it sounds like a really fun industry. If it's not a good industry because you don't have pricing power, at least it's interesting.
Before this, in my college days, I programmed a horse racing program. So that's even worse because they take 20% right off the top.
Sure.
So you're fighting for the 80 cents. And so at least options is, they say, zero sum, or, so that's a lot better. But yeah, no, of course I love it. And like I said, I'm a craftsman of it. We have a great team that's been with us for a long time. It's hard to recreate it because I was a market maker. And on the floor, we came up with, I just noticed all these things, like, intraday movements. We used to download all the tick data that we could and simulate trading gamma. I mean, it's just a weird scalping gamma is a weird way to say it, but a lot of it is using the things that I've learned from horse racing and trading on the floor, and then trying to then using that knowledge to say, these are the data points that can give you some edge. These are some data points that could give you some alpha that not a lot of people are looking at. And here's the right way to summarize. I know market makers. I know how they're, I speak at the industry conferences. I know the market makers that are out there right now. And so I know what to look for and where to find this data. Like someone coming in, like I remember going to the floor the first time I was thinking about it today, just like all the numbers and all the screens and just looking around and going, what are these people even doing down there? But, in a year, then you're like, you kind of know what's going on.
Sure.
But then you have to then translate all that to calculations that are not obvious and proprietary, but then you have to explain it and explain it in such a way that people will depend on it. And then, but you hope that they won't try to recreate it and go do it somewhere else. But again, it's so difficult to do that's where we've kind of hung our hat, and that's where that ORATS is right now. A lot of data, and also using the UI and to help people use it and implement it on a daily basis.
Yeah, you talked a little bit about AI and machine learning, and I'm kind of hearing that you get these intuitions, you've got ideas from experience that are kind of human in nature. It's like, hey, I have this idea, I have this theory. And then is the job a lot about taking those intuitions and ideas and translating it into machine learning and AI so that you can actually test it and see if those intuitions are correct, almost like a scientist combined with a creative type?
Yeah, and it's frankly, it's just a lot of brute testing,
Mm.
and we have these back testers in the cloud that we're testing every delta range, every day range. Should you exit at this point? All the decisions that you would have as a trader, we're putting through the ringer, and we're testing all those things, whether you call it machine learning or just brute force testing, trial and error. We're doing that all the time. And it's useful. I mean, the back tests do the line keeps continuing. So in most cases, meaning the back test results are being confirmed in the future, and so that's the important thing. And that's what that's the way I think that you use AI, you use machine learning as you try to make sure that it's going to work in the future by testing it yourself, testing it in real market conditions,
Mm.
and then having other people confirm it with their quant. However, there's so many random forests. There are so many different things that you could apply to it. But once you've done all that, and you start to see the same types of data fields come out as important, then you have a lot more confidence in what you're doing.
Does that confidence last? I mean, you're talking about the trend continuing in the future. I know you're probably always at risk of overfitting from your backtesting models. Like, how do you just keep retesting and always be looking and seeing if it applied and if it worked, and build almost like you're building like a case for the signal over time so that you don't, you don't overfit basically?
Yeah, I mean, overfitting. You're just naming all the issues that are possible with backtesting, right? And so again, the way that you need to do it, and it's very difficult because if you're backtesting over the last 15 years, we've been in such a massive bull market. I mean, what are you going to do for I think there's going to be a bear market for the next foreseeable future. How are you going to take those backtests that look really good for selling puts that aren't going to be very good for selling puts coming up? So you have to look at your risk. You have to look at distributions. We redistribute and do simulations as well. So, which is a way of saying, take the history, take the look of the distribution, but move it over to the middle, because you don't want to assume that the market's going to be going up 10% a year,
Right.
when you do these tests. So you have to, I mean, the answer to your very insightful question is you have to take the back test and adjust it for certain things. Like our back tester, we could look at just bear market times and how did that strategy do in the bear markets? How did that strategy do in the bull markets? And then that's what you take out of a back test. You don't want to just blindly take a back test and implement it. You want to learn where the alpha really is, and then try to take that and apply that to the markets going forward. Do some forward testing, get some confidence that the back test is still looking like the future returns are looking like the past returns, and then you could get more confidence, rationally get confident in it, and then start to apply slowly what I like to tell people, and really watch your risk. That for me as a trader on the floor that backed a lot of people with my own money, risk is the most important thing, and keeping your position sizing and not getting too crazy. There's a gambling mentality out there. You're going to be wiped out. You really have to identify your alpha and watch the risk that's commensurate with the alpha, and that's how to be successful out there.
Wow. I wrote something down. You said rational confidence. You took something I said. I'm going to save that one because that's really good. I like the idea of simulations. It sounds like you're taking my introduction to analytics training and saying, okay, we can backtest. We might overfit the model, but let's apply the backtest in different future scenarios. So we can not just say, oh yeah, this is going to be a linear relationship going forward, but you've got different possibilities and as a way to mitigate the risk. That makes a lot of sense to me. You just mentioned it again, like the gambling mentality, and you've got these one-day trades sitting out there. And you said something earlier about how the individual traders that came into the market during COVID, they changed the surface of the implied volatility. You can see the impact they're having, it sounds like, in the models. Can you talk a little bit more about that? I'm just curious, like, how are they changing it? Like, what is the difference in the models that you see as a result of millions potentially of these folks sitting at home who are now options traders? Like, what is the surface of the implied volatility now?
Well, and it also speaks to just the massive effect that retail has on the market, and it's undeniable now. So the way that we see it, and it's an interesting way to look at it. So what is retail doing? By the way, they've changed, but let's just say back in 2020, 2021, they're buying these out of the money calls, GameStop, AMC, and I mean I'm talking 1% and 2% chance of getting to that strike, but they're buying them, right? And so what happens is the market makers are short all these out of the money calls, and so they have to start really raising the price. And so they're still buying them, raising the price. So what happens is we could look at what's called a put call skew or a strike skew, where those out of the money a higher strike are getting much higher in implied volatility. And also what we do is we're able to average all of the underlying components for a particular ETF and show that weighted average of skew. So you can imagine we have all these parameters that we calculate, and then we combine the parameters up into their ETF. So like let's say the Russell 2000. So we could see the average Russell 2000 way out of the money call, and whereas it was that implied volatility was usually there's usually a smirk. So the implied volatility of the puts usually higher than the calls because stocks tend to go down faster and people need protection. So they're paying like a higher price for a commensurate low strike as a high strike. But what happened during COVID and when retail came in, they started buying the high strikes. And so whereas usually the highs were 80% of the lows, then they became par one to one, and then they went 10% above. So
Wow.
so that's what we're seeing in the component weighted, especially Russell 2000. The out of the money calls became 10% higher in implied volatility than the commensurate lower strike puts. So people weren't caring about protecting their downside; they were more going after the potential upside and buying those out of the money calls. So hopefully that made sense.
It does. And you were talking a few minutes ago about how when you're backing people with your own money, you got to find the alpha, but you need to be worried about risk and you need to be worried about protecting yourselves. It sounds like these retail traders weren't thinking that way.
Retail, what they're not thinking about risk. They're thinking about, I got $500. I'm going to get on the bandwagons. You only live once, YOLO, and
Right.
all those things. That's what they're thinking about, right? Diamond hands. That's what they're thinking. They're not thinking, I'm going to hedge my upside from Apple with the little downside from Microsoft. They're just saying, I'm going all in on this stock,
Yeah.
and we're taking down the hedge fund. So they're not really thinking about portfolio risk or whatever. But again, that's only a few of them. By the way, that 10% over is now come down to more normal areas, and now retail is it has changed, and they're not doing that as much. I think they're getting options. I do a ton of education. There's a lot of education out there. Obviously, shows like this are helping people really learn about everything that's out there. So, you can't survive that long without watching risk, understanding alpha, and all that. So now I think the retail is starting to get a lot more sophisticated. The retail that I deal with, you can't tell if they're in a hedge fund or if they're just a
Cool.
guy out there. There's just so much education now and so much data out there that you never have access to before, and that's leveled the playing field quite a bit.
Yeah, I love that because that's what we believe in is that if you make data and tools available and people get educated, that you lose that imbalance between Main Street and Wall Street, and regular traders can compete, and it sounds like you're definitely powering that. So yeah, that is a good thing to come out of it. Maybe too many people learned the hard way during that instead of learning through a training technique. They learned by getting skin in the game. And as you see that premium come down and people are starting to protect their risk, it sounds like it just wasn't sustainable for that many people to be taking those big of risks. It just couldn't last.
Yeah, and the market was pretty crazy for a while there, and so they were making some money. Uh, at least people were saying that they were making a lot of money, and
Hmm.
the vast majority of them probably were not. But yeah, I mean, the cloud and technology, and then just the number of explorations, all the options out there, all that is actually fun enough has kind of leveled the playing field a bit. I hope exchange fees come down for market data. That will really help.
Hmm.
PFOP, I'm not a fan of. That's really going to help if they could reduce that at least. And Gensler at SEC is hinting towards that. So all these things are going to it's going to be better for the market long term and better for even everyone involved if we could level the playing field, make the markets more liquid and fair. That's going to, I think, help everyone and especially retail.
Yeah.
With all the tools and all the technology out there, it is the playing field's becoming more level, and it's quite a challenge, and it's quite a mental challenge, and there's always things I'm learning and working on every day. So it's been quite a ride, and I still really enjoy it after 30 years in the business. So.
Yeah, I agree with you. I think that if more people can participate and not have the big returns so concentrated, spread out, society benefits when the rising tide lifts at more folks. I think that's definitely a good thing.
Yeah, and let me just interject. There is a societal benefit, and people just say, "Oh, there's gambling," but like, there's optionality in everything. There's optionality in debt that a company takes on. There's optionality in products that you would invest in. There's optionality in insurance that you would buy, and the pricing of the pricing of optionality is extremely important in a society, for a society that can move forward with all of this information and make better decisions. Optionality is in many of the decisions that are being made. And what's going on in the markets right now are all about valuing different distributions, valuing different odds of things happening. It's valuing optionality, and that's really actually a very big benefit to society.
Yeah, I agree. Can you talk a little bit about what you're working on now? What's coming next for ORATs? I'm been on your website, orats.com again, if you want to check it out. But you've listed some things that are coming, new interval bars, things like this. But like, can you just give us a picture of what you're going to build next and why?
It should be no surprise after listening to us go on, but we're trying to make the access to this huge amount of data a lot easier. So we're partitioning a lot more and really investing a lot in databases so people could download, and not only that, so we could show a lot that's going on. So whereas these signals that I talked about, that forward volatility signal that I used to look at daily, now we calculate it every minute and every 10 seconds. And so, we're just squeezing the time frame down and providing intraday backtesting, providing intraday charting, faster scanning, live data. And what's kind of cool now is the brokers are opening their APIs up. So we could go to Interactive Brokers, we could go to TradeStation, we could go to Thinkorswim, we could go to Tradier, and we can get positions in, and then we could even send trades. So all of those things we're going for right now, and really what it is it's just demand from the clients to have kind of a one-stop shop of great data and be able to see risk and be able to find edge and be able to trade immediately and have alerts and help them trade is really what we've been hearing. And then also, back testing those and then going forward and reviewing it. Now we could take an option contract and watch it through every minute. We could tell, there's this new thing that relatively new, but it's what is the position that the market makers have on, because that affects the market. So we have ways to really identify if the market makers are short or long certain positions and how that affects the market. Signals, how to time your trades, all that's important for and then getting it down to the minute, down to the second. So that's important for effective trading and the ability to compete out there. So that's where we're going with it, Andrew.
Yeah, we've had the CEO of Tradier on, and I like it because the podcast starts to become like a collection of companies that are working together to make trading easier and more accessible, and so that everybody can do it without the headaches. I imagine 30 years ago, none of this was on anybody's radar, that you would have a trading API, you'd have an API where you could get a bulk download of minute bars, and there'd be a database partition to make it easier. And now I can see the distributions of risk. Like, can you just talk a little bit? Like, I mean, you're pushing the forefront of developer experience, user experience, making things more accessible so the traders can focus on what they're good at and finding alpha. Can you just talk briefly about how this whole industry has changed? I mean, it's got to be night and day from the 90s to what's coming in the next few years, as you can not only access the data and analyze the data, but trade on the data and then track your trades. Like, that is just a whole new world that's been created. Can you talk a little bit about that transition?
Yeah, I mean, I remember, I'm going to date myself, early 90s, scanning on AOL for options, and we were pretty advanced back then. But what's happened since then, and Dan Regiu of Tradier and I have worked since they started. As a matter of fact, I helped them right at the very beginning, and we actually provide quite a bit of data, and we have technology that sits on their APIs and users can use. So we're broker neutral, but we've worked quite a bit with Tradier, because I saw that that was really revolutionary just to come out with an API based brokerage firm. But yeah, I mean, now, if you think about trading, often people have other things to do. So, you want to get alerts, but you still want to be in the market. So you want to have, consistently see what's going on. When I was on the floor before cell phones, they had pagers. And so I would see all my positions on a pager. And so now you could see all your positions on your smartphone and see what and here's what to do today based on all this backtesting that we've done. So, where it is now is it makes trading more manageable. Like, you could watch your risk, you know what your strategies are, You could be more systematic about it. Where people fall down is, they'll try something and stop. And then, and then if you look on a backtest, they came in at the exact wrong time. And right after that, if they would have stuck with that program, they would have made all this money. So you want to keep, watch your risk, keep consistent, have good tools that can help you do those. And so that's what we're trying to provide people. And that's how the industry's really changed, is with the APIs, we're able to interface with people's positions and show risk, help them trade easier, and see more what's going on in the market that could help their positions, and find alpha just in general. So that's how it's really changed.
Yeah, I imagine that you used to be more than a full-time job if you wanted to actively trade.
Yep.
And that's why retail can participate now, is because they also have normal jobs. They're out working not in finance. And because they've got tools that make it easier, keep them alerted, allow them to analyze data faster and get access to things without having to spend, 90, 120 hours a week on it, they can actually participate. And it's just because of the tools. The tools are there now. Fascinating. I had a blast in this conversation. Thank you for coming on the show. Absolutely fun to hear about it all and learn about ORATS. ORATS.com. Check it out. Thanks for being on the show, Matt.
Yeah, it was great, Andrew. I mean, unbelievable questions. It was a lot of fun. It felt, that was, a long time, and it went by in 1 second, it felt like. So that was a lot of fun. Hopefully we can do it again.
Yeah, I'd love to. Thanks.
Thanks.